Hello. So now we're on to topic 2, which is credit risk management. The video that I'm making now will be focusing on the first part of this topic, which is the fixed income products. Those are the instruments that are susceptible to credit risk. So I'll be talking about the different types of fixed income products, and then the next video I may actually continue that, because the later ones, forward rate agreements and interest rate swaps, are a little bit more complex. So I might do that in a separate video. Anyway, later videos will have modeling cash flows in the future and finding the net present value of those for different types of products. So what do the cash flow looks like on a bond, for example? You know that, but more complex products, we'll go through them. Then we look at credit risk, and in particular, how the rating agencies like Moody's or Fitch or S&P arrive at a rating for a particular company, and how those ratings may change over time, and how the spread, credit spread, I'll explain what it means, reflects those ratings. And then briefly, in not much detail, how to measure what's called the value at risk of a credit portfolio. In other words, a portfolio of fixed income products. We're going to focus on the interest rate swaps. They are more complex, how to find a swap rate, and also what are the factors that are driving this enormous market, the biggest market in the world. Finally, we'll look at credit derivatives and how their trading precipitated the banking crisis of 2008. So, first of all, fixed income products. So these are the products that have a credit exposure. Things like stocks have virtually no credit exposure. Because when a company goes public, it's usually a very large public company that is unlikely to go insolvent completely. Nevertheless, they have a considerable market risk, which we'll be focusing on in subsequent topics. But this topic, we're just focusing on loans, bonds, fixed and floating interest rates, floating rate notes, forward rate agreements, interest rate swaps, and also later on, when we look at credit derivatives, we'll have a look at structured products like mortgage-backed securities, or more generally, asset-backed securities. Now, loans and swaps and the forward rate agreements that constitute swaps are traded over the counter. So they're legal agreements between two counterparties, well, they're lawyers, and they're not traded on exchanges. But notes and bonds are issued into a primary market. They're issued by governments and corporations, and then they're traded in the secondary market on exchanges, or more generally, specialized electronic platforms run by bond dealers. Notes are just shorter-term bonds. Structured products are also traded in primary and secondary markets, but they're typically over the counter, but they can be on electronic platforms. There's a very broad variety of structured products available. So let's go back to loans, which you will have covered already. So this is just to remind you of some of the key terminology. The obligor is the borrower. That's the party taking out a loan. And the obligee is the lender, the party providing the loan. Usually it's a company that is the obligor and a bank that is the obligee. The amount of money borrowed is the principal Could be a small loan like $10,000. By the way, I always use dollars, even, well, sometimes I use pounds and things, but usually I measure things in dollars just to say, it's a nominal amount. It's not a notional amount, it's a nominal amount. Nominal and notional are different. Notional is just not a traded amount. It's an amount that we base payments for forward rate agreements and swaps on. It's also the amount for any derivatives type contract. But in loans and bonds, there is a principal amount, which is actually changing hands. Cost of borrowing is the interest rate, and the duration of a loan is called the maturity of the loan. Interest rates are usually quoted per annum, so you have to sometimes break them down if you're just looking at the interest over a certain period, like over 6 months or 3 months. We'll do some of that in our calculations later. So as I said, a note is a short-term bond, but there's something even shorter called a bill. And these are usually up to 1 year. And these have no interest payments. They're what we call zero coupon bonds. But they're issued at a discount to the face value and then redeemed at the face value. So you make your yield, because if you buy at 97 and then a month later you redeem it at 100, you will have made $3 out of 97, so almost 3% over that period of holding it. We'll talk about how to calculate the return on a bill, or called the simple yield it is. The notes usually have coupons, but not always, and their maturity up to 10 years. And they're usually issued at face value, but sometimes you can get zero coupon notes that are issued at a discount. Bonds always have coupons. They can be fixed or floating coupons, of course, and usually over 10 years duration, maturity, and the face value is where they're issued at. That's the principal amount stated on the bond certificate. There's something also called par, which is the amount repaid at maturity, the redemption value, but this is almost always set to be the face value. So I won't talk about that distinction. Okay, let's talk about bills first. In other words, discount bonds or zero coupon bonds. And as I said, they're sold for less than their face value, and the full face value is repaid at maturity. They can be issued by governments or corporations. And if they're issued by corporations, they're called commercial paper. It's a way for companies to have short-term financing. A typical example of a discount bond is a US Treasury bill. So you can get T-bills of different maturities up to 1 year. Now, the profit that the bondholder makes is just the difference between the face value, which we're going to call F, and the purchase price, P. And the simple yield is just the return. In other words, F minus P over P. But it's the annualized return. So if the bond is a 1 year bond, then the return, the simple yield is just the return. But if it's a 6-month bond, then over a year, you would get twice the 6 months return. So if T is a half, in other words, it's a 6-month bond, your simple yield, which is always in annualized form, is 2 times the return. That's because when T is underneath, it's the same as multiplying by 2 when T is a half. For example, what's the yield on a 3-month T-bill purchased for $98? So the face value is 100, P, the purchase price is 98, T is 3 months or 0.25 years. And using the formula, we've got 100 minus 98 over 98 times 1/4, which is 4 times 2 over 98, which turns out to be 8.16%. Now, notes typically have a maturity between 1 and 10 years, and they often have variable coupon payments, in which case they're called floating rate notes, or FRNs, as opposed to fixed rate notes. The interest payments on an FRN fluctuate. They're based on some sort of variable benchmark called a reference rate, plus a spread, which depends on the credit rating of the issuer of the note. So the reference rates used to be called LIBOR or Euribor, and there was a whole curve of those. So 1 month, 3 months, 6 months, LIBOR going up to 2 years or more. But that's been replaced now with, in the UK, because LIBOR used to be the London interbank offer rate. So it was what banks quoted to each other for borrowing and lending between banks, interbank. Anyway, that's not used so much now. There was a big scandal about LIBOR rates being fixed by a cartel of dealers. And now we use the Sterling Overnight Index Average, SONIA, or in the US, it's the Secured Overnight Financing Rate, and in the EU, it's the Euro Short-Term Rate, and various other equivalents for other countries. So these are very short-term rates. And if we want to have a reference rate of a longer maturity, like a 6-month reference rate, we need to compound these rates to longer maturities to get the relevant reference rate. FRNs are popular because they offer protection against changing, or rising anyway, interest rates. So rather than buying a fixed coupon bond, which is always paying 5%, if interest rates go up, that's not going to change, but your FRN will have a higher coupon payment when interest rates go up. So you prefer them when you think interest rates are going to go down, but you wouldn't prefer them to the fixed rate if you think interest rates are going to go, if you think interest rates are going to go up, you prefer them to fixed rates, whereas fixed rates are preferable when you think interest rates are going to go down.